Osborne Manufacturing uses a predetermined overhead rate of $18.20 per direct labor hour. This predetermined rate was based on 12,000 estimated direct labor hours and 218,400 of estimated total manufacturing overhead. The company incurred actual total manufacturing overhead of $215,000 and 11,500 total direct labor hours during the period. Determine the amount of under or over applied manufacturing overhead for the period, and then assuming the entire amount of under or over applied overhead is closed out to cost of goods sold, what will be the impact on the company's gross margin during the period? We were told that our actual direct labor hours were 11,500, and we'll multiply this by our predetermined overhead rate, which we were told was $18.20. We could have calculated this taking our estimated overhead cost of $218,400 and dividing it by our estimated activity level of 12,000 direct labor hours. This means we will apply $209,300 in manufacturing overhead. The actual manufacturing overhead incurred was given as $215,000, which means we had $5,700 in under-applied overhead. If we look at a T account, we can see this because our actual manufacturing overhead comes in on the left-hand side of the account, and that was given. We credit manufacturing overhead for any overhead that's applied, and we can see we have a remaining debit balance of $5,700. This means that we did not apply enough overhead to our jobs. Our manufacturing overhead was under applied. Therefore, to close out manufacturing overhead, we will need to credit it for $5,700, and we will then debit cost of goods sold for $5,700. Recall, if our applied overhead is too low, then our work in process will be too low, and our finished goods will be too low, and our cost of goods sold will be too low. This entry then increases cost of goods sold, and it will decrease our gross margin.